Pattu from freefincal, and in this video let's talk about an important concept called duration, and this is crucial measure of risk if your mutual fund invests in bonds. It doesn't matter whether they are debt funds or arbitrage funds or hybrid funds or even equity funds. Many equity funds also invest in bonds. If they invest in bonds, then this idea of duration is important. Now, if you go to any value research fund page, for example, this is ICICI Gilt Fund. If you go to this portfolio page, you will see these numbers. Number of securities, that's the number of bonds. There's something called the modified duration in years, 2.88. We'll talk about that. Then there's something called average maturity. So this is simple to understand. So this is the weighted average of the maturity periods of each of those 23 securities. So there are 23 bonds. If some of them mature in 5 years, some of them mature in 10 years, some of them in 1 year, and so on. So depending on their weight in the portfolio, this is the weighted average maturity in years, and this is a very important, simple to understand concept. Modified duration may be slightly difficult for people, many people, but we will try to explain that. Yield to maturity is if the fund manager decides to never sell these 23 securities until they mature, then the portfolio will give 7.74% as the yield. But we will talk about what yield is. But don't take this yield to maturity too seriously. Many people, especially distributors, missell debt funds using this YTM or yield to maturity. In an open-ended debt fund, this means nothing. Just completely ignore it. Doesn't mean anything other than higher the yield to maturity, higher will be the risk in the portfolio. If the yield to maturity is 6, it means the fund is more or less, according to current interest rate levels, more or less taking low risk, invested in low risk bonds. If the yield to maturity is 9 or 10, then it's extremely risky. If you go to many Franklin funds, if you look at the yield to maturity, it will be very, very high. Don't look at this and invest. This is dangerous. This is a measure of risk, not a measure of return. Again, big mistake many people do. So let's get back to this presentation. I have a detailed post on what is duration, what is something known as Macaulay Duration that SEBI has introduced in the categorization, and I've also explained what is modified duration in that post. Those who are interested in examples, numerical examples, and definitions can look at that. I'm not going to put in all the numerical examples here, but that because it will become a little cumbersome and make it difficult to watch. So let's begin. But before we begin, today Avinash Luthria has published a wonderful guest post on the S&P report on active versus index funds. This was published first as early as 2010, almost a decade ago, and he has written why he believes that people who read this report will change the way they invest. I think it's a must-read post. Look at check out this link, and also I'll put it in the description box. Also, keep the questions for the Q&A coming. There are some wonderful questions in yesterday's video. Please keep them coming. I will handle them all together for tomorrow. So let's begin. So first we need to understand the idea of yield. What is a bond yield? So suppose let's consider a bond which is priced at 100 rupees and it's offering 10% interest rate. So the yearly interest rate would be 10 rupees, right? For the 10%. So the yield is defined as interest divided by price, or in general, interest divided by current price. So 10 by 100, that's 10%. That's called the yield. Now, suddenly if there are new bonds available in the market and those bonds are offering 11% coupon rate or 11% interest rate, then the old bonds will become less attractive. Why will somebody buy a 10% bond when there is a 11% bond available? So we have to make this 10% bond attractive to the buyer. You cannot change the 10% interest rate, at least for this kind of a bond. So the only place you can change is the price. So obviously you have to offer this 10% bond at a lower price. Then only people will buy it. But how much low? Let's do a simple calculation. Suppose the price, this 10% bond is priced at 90 rupees. Then the new yield will be interest rate of 10, that will not change, divided by the current price of 90. 10 by 90 that will be 11.11% yield. So now a new bond is available for 11% yield. The old bond has now become 11.11%. So now this becomes a little bit more attractive for people to buy the old bond. That's how the bond market functions. So once the interest rate increases, that is new bonds are available for a higher interest rate, then the prices of the existing bonds will come down and the yield of the existing bonds will increase. So when the price decreases, yield increases. Price and yield have a inverse relationship, and this is essential to understanding bond risk. So I have now plotted two price is in the y-axis and the yield is in the x-axis. This is for a 2-year bond, price versus yield, and this is for a 20-year bond, price versus yield. Now look at this graph. I'm not going to get into the formula and what is the shape of this graph, how does why is the shape like this, what is the slope and so on. I'm not going to get into the mathematics of it. It's fascinating mathematics. You should read it. Get a proper portfolio management book and read it. It will not disappoint you if you are a student of the subject. But as an investor, I don't think there's a need to go into such levels of detail. Except that it is an inverse relationship, what I told you. That much is intuitive and logical. Now, look at this vertical rectangle. I have considered a change in yield of that much, of about that much, that width of that rectangle, that's the width. I've considered the change in yield. It's the same change I have considered for the 20-year bond also. There's a change in yield of the 2-year bond, there's a change in yield of the 20-year bond. Now, for this change in yield, if you look at the change in the price, this is the price. That small horizontal rectangle represents the price. The width of the horizontal rectangle shows the change in price. So when the yield increases this much, the price drops down that much. The price drops down that much. Now come back here. For a 20-year bond, for the same change in yield, the price drops down a lot more. And because the curve is a lot more steeper, the slope is a lot more steeper. So this is how bond risk works. Higher the duration of the bond, the more the price of the bond will change or fluctuate for small changes, for the same change in yield. So here the change in yield is the same, few percentage. For the same change in yield, the 2-year bond only falls by a little amount, the 20-year bond falls by a large amount. So the price of a bond fluctuates with yield more if the duration is more. That is why duration is important in debt mutual fund investing, or whenever a mutual fund invests in bond. So the longer the duration of the bond, the more sensitive it will be to yield changes. So it's the more sensitive its price will be to yield changes. That is what if you understand this slide, I am done. I mean, you don't need to worry about basically your mutual fund risk idea is the essential day-to-day mutual fund risk idea is covered in this slide as far as I'm concerned. So now we will define a natural way to define this risk is to look at the slope of the graph. If you look at do you remember your school calculus? How do you find slope? The change in the y-axis divided by the change in the x-axis. That's called the slope. So the change in bond price divided by change in interest rate or change in the yield. That is called the slope of the graph. The slope, because the line is falling down like this, the slope will be negative. So to make it positive, we'll just multiply it by -1. And that is the definition of what is known as the modified duration. So the modified duration, which is usually measured in years, tells you how much the price of the bond will move up or move down for a given change in yield or the interest rate. So suppose the change in the let us say the change in the interest rate is 1%, and if we looked at the ICICI Gilt Fund, it has a modified duration of 7.8 years, right? What is the modified duration? Modified duration is 2.88 years. So for 1% change in interest rate, the NAV will move up or move down by 2.88%. So how do you know that? Well, suppose if the interest rate is cut down, then existing bonds become more valuable because they will have higher interest rate. So if the interest rate falls down by 1%, existing bonds will move up by, the NAV can move up by almost 2.88%, approximately. If the interest rates move up by 1%, the NAV will fall down by again 2.88%. That is how modified duration is measured. Unfortunately, SEBI does not use modified duration. It uses something called the Macaulay duration. The Macaulay duration does not tell you the sensitivity. It does not tell you the measure of risk. It just tells you how long it will take for an investor to recoup money. I don't think it's so important for investors to worry about Macaulay duration. But if you're interested, you can look at my post. It's there in this button. So this is essentially how risk works, interest rate risk works, and this is day-to-day volatility. And typically what happens is, because more and more people start buying bonds, the bond market will start anticipating and speculating more and more about what will RBI do. See, earlier, the response to RBI action was not so, what can I say? What not? Let me put it again this way. So let's say the RBI is going to meet 1 month later from now. Bond prices will start reacting to that. If people in the bond market say RBI is going to increase interest rates, then they will start winding up the old bonds and start buying short-term bonds and wait for the new bonds to come in. And or they can do the opposite when they expect the interest rates to fall down, or vice versa. So when I say 1% change in interest rate and 1% up or down movement in interest rate, it will not happen suddenly. It will happen more gradually. That's what I'm trying to say. The market will already price in that information much before the actual event of the RBI quarterly meeting occurs. That's what I'm trying to say. I hope I did not confuse you saying that. So that's it. That's what I wanted to say in this video. If you have any questions on this, please let me know. So again, the message is, higher the modified duration of a mutual fund, higher will be its sensitivity to interest rate changes, and longer the tenure of the bond. So that is, if for example, if you go back here, this is a gilt fund, and the gilt fund holds about 4.8 years. For a liquid fund, this will be about this will be much less than 1 year. It will be like 0.2, 0.3 or something like that. So for a fund which has got an average maturity of 1 year or less than 1 year or half a year, that will respond. Its sensitivity to interest rate changes will be much lower than that of a gilt fund. So that's the problem in the gilt fund. Although it may not have credit problems, there is a vertical drop in NAV may not occur, it will still respond gradually or suddenly to interest rate changes, that is the yield changes in the market or the price changes of the bonds. And sometimes even over 1 year the NAV may not even move up. So you must be careful. So you cannot assume just because something is risk free, you have to pay a price for getting that risk free product, and that is returns can be this way or that way. So that's what I wanted to say in this video, and I'll catch you again later. Bye.